Tesla stock is back in the green by about 1% today, and after all, it looks like the sell-off was short-lived. Earnings came in better than expectations. What did you expect? Tesla wasn't going to crash and burn. We've been talking about this here on the channel. There's a lot of great things to look forward to. And as we get closer to the end of the rate hiking cycle and ultimately the first rate cut, well, these valuations can be a little bit more supportive, and even, as an analyst says, Tesla stock is undervalued. We're going to get into all of this, everything happening on the day, everything you need to know. If that sounds like something you want to be a part of every single day, stay up to date with the broad markets. And boy, we're going to talk about those because next week you got big tech earnings as well as the NASDAQ rebalancing. This has only ever happened twice in history, and it's probably no surprise it's happening last week. So let's go ahead and get into it. Hit the subscribe button as well as the like button. If you guys also want to come trade with me live in real time every time I make a trade, link down below in the description of this video. That's not like a texting type of thing. You can come actually talk to me 24/7, 7 days a week, anytime that you would like on any problem or issue or great things that are happening to you. Tesla stock today is up about 1%, and it's forming a hammer candlestick pattern. Now, what a hammer candlestick pattern is it looks like a hammer. You have this low wick showing an intraday low with a recovery towards the end of the day. This shows that the sellers are getting exhausted and the buyers have stepped in. Every time that you get this hammer candlestick, you typically lead to more upside in Tesla stock. Take a look at the charts. Here was, to some degree, a hammer candlestick, and Tesla stock rallied the next 3 days later. Back here was a hammer candlestick pattern. You bottomed the next day after a 3-day sell-off, and you continued closer to about $300 per share from about $267. Same story every time. Once you get these hammer candlesticks, it's usually a good sign that a reversal is coming and the buyers have again stepped back in. Tesla's MACD has curled down. The yellow line is below the blue line. This is not necessarily a good sign. Overall, you still have a lot more momentum than you have seen in other cycles. So we will watch this closely. Although it's not a great sign, it doesn't mean things have to get worse from here. That's why I don't always like to talk about the MACD, especially on the downside. It's more of a better indicator when a break happens or a break under happens. The RSI has also reset back to neutral at 50.24. 50 is neutral. So you're no longer overbought, you're no longer oversold, but notice Tesla stock at the time of recording this video is $263 per share. It looks like you may have bottomed and hit a low of this sell-off right at about $255 earlier in the day today. Tesla stock has recovered $8 since then. Again, with the hammer candlestick, something notable that should lead to a lot more support. The way that I look at it, as long as earnings next week with your Microsofts, your Googles, your Amazons, your Facebooks, your trillion-dollar companies or almost trillion-dollar companies, if they're bad, well, Tesla could fall further. If those earnings are okay and they're at least decent, this likely is the bottom of the sell-off, at least in my personal opinion. Another Cybertruck was spotted driving on the freeway today, and again highlighting that production and ultimately deliveries probably getting very close. Lucid had some very favorable things to say about Tesla, calling Tesla the cool kid on the block, but there's plenty of opportunity for other EV manufacturers to grab a piece of the pie. This comes from Andrew Liveris, former CEO of the Dow Chemical Company and Lucid board member, stating in a recent interview, quote, "I'd like to think that there's enough total available market for all of us as internal combustion engines fade away." And we have another analyst that is smoking funny things, saying Tesla stock is worth $26 a share and is one of the most overvalued stocks in the market. David Traynor, CEO of investment research firm New Constructs, argues that Tesla's stock is significantly overvalued, estimating its worth at just $26 per share, which is roughly a tenth of the EV giant's Thursday's closing price. Trainer's bearish outlook is based on several factors, including falling demand, deteriorating margins, and a massive cash burn. He also criticizes the over-reliance on Tesla's full self-driving business and EV charging network for the company's valuation, as these segments are not currently materially contributing to the bottom line. Again, this is the same argument that this guy and many other bearish analysts have had on Tesla for years now. Same thing, over and over and over again. No matter how much Tesla proves them wrong, they continue with the same thesis. None of these things are correct. Falling demand, not correct. Deteriorating margins, sure, still multitudes better than the auto industry itself. And more specifically, Tesla is not just an automaker. What about energy storage? What about Dojo? What about full self-driving and the capacity to license that to other OEMs, in which Elon said that they're actually in discussions with at least one OEM manufacturer, a major OEM manufacturer, to license full self-driving. These things are all going to have huge effects to Tesla's bottom line, and to make these arguments just sounds unknowledgeable at this moment in time. Besides that, Elon Musk just got $18 billion poorer on Thursday as Tesla stock fell. Elon's net worth slipped from $256.8 billion to $238.4 billion, according to Forbes calculations. Elon Musk also confirmed on the last earnings call that Tesla's stock could 10x, as Cathie Wood has predicted. ARK Invest said in April that Tesla would be worth $2,000 per share by 2027. ARK Invest updated its price target last in April. This was the last time we have heard from an official price target from ARK Invest. Tesla stock was trading at $160 per share at that time, less than 10% of the value ARK predicted Tesla will see over the next 4 years. Elon said on the earnings call, quote, "I have very high confidence in the long-term value of Tesla. I see it. I really see a path to a 10x, maybe call it a 5x increase in the value of the company," Musk said. "Maybe a 10x, where things go along the way, the trials and tribulations, and the mood of the markets one cannot predict." Saying, hey, in the short term, yeah, markets might not like what we're doing. But in the longer term, you're all fucked and you're all screwed. Sayonara to the shorts. Tesla's stock has a $10 trillion opportunity in artificial intelligence, AI software, and services. According to Elon Musk, we could see full autonomous driving software by the end of this year. FSD software addresses two massive market opportunities: autonomous vehicles and robotaxi services. According to Precedence Research, the global autonomous vehicle market is expected to grow at 40% annually to reach $1.8 trillion by 2030. Tesla can, of course, monetize that opportunity by selling its FSD software directly to consumers, but the company is also willing to license its software to other automakers. And I've talked about this a lot in the past, and I will reiterate it again if you have not heard. But there's no catching up to Tesla. I think that's pretty clear. Nobody even stands a candle to Tesla's full self-driving. And the bears that want to say, well, there's robo-taxis in San Francisco or other select cities in California and around America. Sure, that is true, but those softwares, those programs cannot operate outside of those select cities because they're trained for those cities. Well, what Tesla is doing is trying to autonomize the whole US, really the whole world at the same time. So it takes a lot longer, but once it's solved, it's going to be solved for everywhere. That's the big difference between Tesla and other, I guess, FSD software programs. There's really no comparison in that regard. ARK Invest estimates that autonomous ride-hailing platforms will earn $9 trillion in annual revenue by 2030. And McKinsey says robotaxis will handle 8% of global transportation by 2035. up from roughly zero today. To capitalize on that, Tesla plans to mass produce a robotaxi in 2024, and Musk recently discussed plans to launch an autonomous ride-hailing network that will also crowdsource at rest vehicles from customers. The company has yet to set a specific date for such a service, but if Tesla manages to solve full autonomy this year, it may launch an autonomous ride-hailing network in the very near future. In any case, Tesla is well positioned to be an important player in autonomous vehicles and robotaxi services, two markets that could collectively be worth $10 trillion by the end of the decade. Specifically, the company has more autonomous driving data than any other automaker, an advantage that hints at superior FSD software, given that data is crucial to training AI models, and its cars are equipped with what Musk calls the most efficient interface computer in the world. This is not to mention Dojo and the supercomputer services. This is not to mention Dojo, a supercomputer service. Dojo is expected to be fully operational later this year, at which point Tesla could theoretically sell AI cloud services to other companies. Musk says it's a long shot bet that would put Tesla against cloud titans like Amazon Web Services and Microsoft. But Dojo could be the foundation of a business worth hundreds of billions of dollars in the future. And then software and services could supercharge profitability. Tesla's already one of the most profitable car makers in the world. The company reported the highest operating margin in the industry last year, an achievement that Musk attributes to superior manufacturing technology. But management believe FSD technology will be the primary source of profitability in the future. Musk says full self-driving technology could push Tesla's margins to 70% or higher in the future. That's because even if you make a 10% margin on the vehicles, if you're selling FSD software for 10 or 15,000 at 90% margins, well, that's where you could get very profitable pretty quickly once you do ultimately solve full self-driving. In other news, Maybank welcomes Tesla and will act as a key EV financer in Malaysia. Tesla buyers opting for financing with Maybank will enjoy preferential and competitive financing rates as well as flexible repayment options with up to 90% financing through Maybank's EV financing. This is after Tesla announced that they will start selling the Model Y in Malaysia. Maybank is the largest bank by assets under management in Malaysia, and this could be a positive for Tesla. We'll see down the line how much this actually gets utilized, but if Malaysia becomes a bigger source of selling Tesla vehicles as it is a brand new market, well, this could materially add to Tesla's bottom and top lines. We have another article out from the Motley Fool today, and I really like this one. They say one reason Tesla's high stock price may actually make sense. Given the stock's approximately 10% pullback on Thursday, investors can find whatever reason they want to look at Tesla and criticize Tesla or any other company for flaws, but there's one area it has arguably succeeded virtually every critic's expectations in recent years, and that is sales growth. Rewind to the end of 2020 when the automaker delivered about 500,000 vehicles and net income for the full year was $903 million. Few would have guessed that by the end of the second quarter of 2023, Tesla would be delivering nearly 500,000 vehicles quarterly, yet Tesla's doing almost exactly that. Second quarter deliveries came in at 466,000. Even more, net income came in at $2.7 billion for the 3 months, dwarfing Tesla's annual income just a few years ago. Sure, we could dwell on the fact that Tesla had to significantly reduce the prices of its vehicles this year to aid its sales growth in the face of rising interest rates, but when investors zoom out a few years, it's easier to see and to appreciate the magic of what the company has done. In Tesla's 2020 fourth quarter letter to shareholders, management said it expected to grow deliveries over a multi-year horizon by an average annual growth rate of 50%. Now Tesla can reflect on this bold prediction with pride. Even more, pulling off this growth helps make the company's forecast for more of the same in the coming years more believable. We are planning to grow production as quickly as possible in alignment with the 50% annual or compound annual growth rate target we began guiding for in early 2021, Tesla said in its second quarter 2023 investor update. In some years, we may grow faster, and some we may grow slower, depending on a number of factors. But what people forget is more deliveries equal more software revenue. Price cuts or not, Tesla will likely be putting millions of cars on the road per year next year. Further, these vehicles could generate significant revenue for Tesla over their lifetime via software sales and subscriptions for the company's driver assist technology. Finally, Tesla can potentially make even more money from its driver assisted software as it works towards solving autonomous driving. While much speculation is still required to justify Tesla's current stock price, its sales momentum in such a difficult environment is jaw-dropping. Tesla will continue to silence the doubters, as this article says. As we wrap up this major day of trading right before the NASDAQ rebalancing, today is a $2.4 trillion options expiration date. And what this means is a lot of options are going to come due. But even more than that, there's going to be new positioning. There's going to be new options taken out. And especially as volatility has been so low recently and you've seen stocks basically only going higher, this could add to more of a downside pressure for next week. The NASDAQ has only done a special rebalancing twice in its history. In May of 2011, 3 months later, the NASDAQ fell almost 20%. And back in 1998, and again, 3 to 5 months later, the NASDAQ fell almost 20%. This is, or would not be, a big shocker if the third time around we also fell about 20%. Now, a lot of analysts have taken to CNBC and other news outlets to say one thing in particular that I find interesting. The NASDAQ is rebalancing its portfolio on Monday. You start getting your $1 trillion tech earnings on Tuesday. Coincidental timing? Maybe. Maybe they know something. Well, maybe. Something to keep your eyes on. I don't think this is a coincidence. Even if it does not mean earnings are going to be terrible, this is probably not a coincidence. Now, Apple will be reduced from 12.06% to 11.05%. Microsoft will see its biggest reduction out of all of these other names, while Nvidia is close, going from 12.74% to 9.80%. Alphabet going from 7.61% to 5.7%. Amazon from 6.91% to 5.3%. Nvidia from 7.28% to 4.3%. Meta from 4.46% to 3.7%. And Tesla from 4.44% to 3.4%. This probably another reason why maybe the sell-off after earnings was a little bit larger than a lot of us would have expected.